It's Friday, 14th of February, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, Germany's election, who's going to win, and what will or won't they do to fix the economy, and how at risk is Europe from Trump's trade agenda. But first, Neil's out this week, but I'm happily joined by Deputy Chief Markets Economist Jonas Goltermann. Hi, Jonas.
Hi, David.
It's Valentine's Day. Nothing says romance like tariff threats and financial market performance. It's morning in London. The US Open is still a few hours away. For the record, S&P futures are down just a teeny tiny bit. But Jonas, I was hoping we could take the market temperature as it's just over 3 months since Election Day lit a rocket under the Trump trade. Firstly, though, it's been another interesting 24 hours in Trump land, hasn't it? Why do you think the reaction to the reciprocal tariff announcement on Thursday was greeted so positively in the equities market?
Yeah, it's an interesting one. Obviously, the dollar was down quite a lot on the announcement as well, which I think is maybe even more surprising. But it does feel a bit like a classic buy the rumor, sell the fact kind of reaction, where the expectation of something is much more powerful than the actual thing itself once it's announced. Hopefully that doesn't apply to everyone's Valentine's today. If you go back to the market, it's looking, basically investors have taken a glass half full view of the announcement and focusing on the positives, which I think there are obviously some. First of all, there were no new tariff specific numbers announced yesterday. There was no specific deadline for when new tariffs will be decided on or whether it would be implemented. There was some reports ahead of time that would be the case, but in the end, there was a bit fuzzier. And you can interpret that as the can being kicked down the road. Maybe these tariffs won't happen, or if they do happen, they won't be quite as big or as big of a shock as maybe had been feared ahead of time. But the whole process is going to be more gradual than the impression we all had listening to Trump on the campaign trail and even over the past couple of months. The other feature of this approach is that it gives more time for negotiation. So other countries can look to placate Trump by making concessions or cutting a deal of some kind. Canada and Mexico have already done that with respect to the 25% tariffs that Trump announced early last week and then suspended. So it leaves room for discussion. This whole reciprocal tariff framework, it's more complicated but also more flexible than the kind of universal blanket tariff that Trump talked about previously and during the campaign. So yeah, again, that makes negotiations more plausible. And of course, we all know Trump loves a good deal. So I guess the thinking is that he can be optimistic on that front because he loves, just as much as announcing tariffs, even more so, he loves announcing that he got a good deal by negotiating hard. And final point is that the Trump trade, broadly speaking, especially with respect to the dollar, had done very well since the election, but was starting to look a bit stretched over the past few weeks. Positioning was already very heavily long dollars. And that kind of situation leaves you vulnerable to a correction if the narrative changes, which seems to be what's happening as we speak.
So all that being said, the market, as you say, has taken a glass half full approach. I think the point that Neil certainly made in his note last week, yes, Trump likes to make a deal. Also, perhaps the market's becoming inured to these tariff announcements. The Canada-Mexico tariff, that was taken negatively, but then Trump appeared to back away from it in response to how the market took it. But there's a danger here, isn't there? There's a danger of complacency that, like the boy who cried wolf, eventually the wolf eats the boy. Eventually, we're going to get tariffs in that are harmful to the global economy, that are harmful to the US outlook, right?
Yeah, I think that's definitely the case. I think the announcement yesterday is a different approach than the universal tariffs that we had thought were going to come in. Our forecasts assume a 10% universal tariff coming into effect at some point in the first half of this year. And it's now a bit less clear what the tariff rate that administration wants to set will actually be. It's actually quite a lot more complicated. And the announcement yesterday left a lot of details unclear, as you might expect. But it could very well mean that the effective tariff rate on US imports, in the aggregate, ends up being more than 10% under this approach. Some rudimentary sort of back on the envelope calculations suggest that might very well be the case, but we just don't know how mechanical the approach that the Commerce Department is going to take. And overall, it might take longer to implement this approach. In a sense, there's more uncertainty, I would argue, today than there was yesterday. But overall, our sense is still that Trump, he very much wants to bring in tariffs. He wants to bring down the US trade deficit, and he thinks tariffs are the way to do that. And much as he likes cutting a deal, I think in his mind, this is still going to end up with having your cake and eating it too, both tariffs that bring in money and bring down the deficit and deals that he can trumpet as big wins. And in particular, if you look at the overall framework that they're bringing in now, is not just that tariffs that other countries have on US exports, but they're also going to consider the value-added tax that many countries have, or sales taxes, which in the US there is no VAT, and also a range of other non-tariff barriers like regulatory constraints and things like that. And that lend itself really to larger tariffs on China in particular, because China famously has a lot of government subsidies and a lot of behind-the-border implicit barriers to imports. And so we still think that Trump is going to target China for the biggest tariff rates. And that if that proves the case, we probably are going to see a stronger dollar off the back of that, in particular against the renminbi.
Based on all you said, the Trump trade, this understanding that Trump coming back into office, his policy agenda would translate into stronger dollar, higher treasury yields, higher equities prices. For all intents and purposes, it sounds like that idea, that phase is over. What follows? What comes next?
I think the way I would frame it is that the initial stage post-election, but pre-inauguration, which was all built around expectations, really, not the fact of what policies it going to bring in. That phase is over, and as you've seen, a lot of the Trump trades, definitely dollar to some extent, yields and equities as well, stall out over the past few weeks. US outperformance in equity world in particular has gone into reverse. And we now need some more meat on the bone. We need the actual policies to lead into the next stage, if you will, of the Trump trade, based on the reality of Trump in office rather than expectations of Trump in office. And I think on that front, markets are very impatient. We're just 3 weeks in, but there hasn't been enough meat on the bone yet. All this talking about tariffs, it's been interpreted as more smoke than fire, like tax cuts that are also expected. Those have to go through Congress. That we haven't heard too much about that, very large numbers being bandied about, but obviously that takes a long time. Legislation takes months, not weeks. And it's actually very similar to what happened in 2017 when Trump came into office back then, similar to what we saw at the end of last year into this year. Expectations were running really high, and back then it was focused mainly on the big tax cut package. But it took a lot longer than markets wanted it to in the end. The tax cut package didn't come through until December of 2017. Congress focused on other things first, and only then did they get back to the tax cut package. But once that happened, you got to the second stage of the Trump trade in 2018 and 19, which was US outperformance, stronger dollar, higher yields, and so on. I don't think it's going to take as long as that this time around, but we might now be in this kind of interim period where we're waiting for more meat in the bone, things to actually materialize, in particular in terms of tariffs, but also in terms of the broader Trump agenda in Congress, which is obviously more complicated. You can't just do that with a stroke of a pen. The legislative process in the US takes a lot of time, no matter who's in charge.
That was Jonas Goltermann on the Trump trade and the latest tariffs announcement from Washington. The news cycle is in overdrive, but we are keeping clients ahead with the latest analysis and data tools. It goes without saying, if you do have specific questions about the new administration and the macro market implications of its policy agenda, do drop us a line and we will get you in touch with the Economist team. Now, Germans go to the polls on the 23rd of February following the collapse of the traffic light coalition last year. This is an election that's being held against an extraordinarily challenging backdrop for Europe's biggest economy, with growth basically stagnant, pillar industries facing existential competition, and Donald Trump back in the White House apparently looking to tear up long-standing trade and security arrangements with Europe. To find out what's at stake and the chances for a shift in the German economic narrative, I spoke to Andrew Kenningham, who's our chief Europe economist, and Elias Hilmer, who's an economist on our Europe desk. In this discussion, we talk about Germany's weird fiscal stance, we talk about the ability of its companies to compete, the threat posed by Trump tariffs, but also US disengagement from Europe. It starts with Elias on what to expect from election day and its immediate aftermath.
Yes, so the elections are on the 23rd of February, and while the results will probably be clear by the end of the day, it usually takes a while in Germany until the governing coalition or the new governing coalition has formed. In the past, somewhere between 1 and 3 months, depending on how tough the negotiations between the different parties were. But at the moment, based on current polls, it looks like the CDU will be the senior party in any governing coalition. And in the polls, the CDU is followed by the right-wing populist AfD, who won't be part of any government because all major parties have ruled out that they would work with the AfD, followed by the center-left SPD and the Green Party. And there has been quite a shift in polls in recent weeks. And it now looks also likely that the left-wing party, Die Linke, will also enter the parliament as well. Die Linke has no chance of being part of any governing coalition as well, but their entry into the parliament has made the formation of potential future governing coalition a bit more tricky. And it also means that the majority of a potential coalition between the CDU and the Green Party will be very slim, just around 50% probably, based on current polls. So it looks very likely that the next chancellor will be Friedrich Merz in a governing coalition with the center-left SPD. This grand coalition has ruled Germany, or has governed Germany for a while in the past under Angela Merkel. She governed with the SPD for 3 out of her 4 terms. And yeah, that's probably the most likely outcome based on current polls at the moment.
And just to be clear, you mentioned the AfD, the Alternative for Germany, this far-right party, that will have no place in any kind of coalition that comes out of this election.
Yes, indeed. All major parties have declared that they won't form a coalition with the right-wing AfD party. Yeah.
The GroKo, you taught me this word earlier this week. I didn't realize it was 2013's word of the year in Germany. What have we learned about this coalition in terms of its ability to get things done?
So the GroKo, or Große Koalition in German, Grand Coalition, has governed Germany for quite a while in the past under Angela Merkel. It was a period of remarkable stability politically, and also a period of economic stability, so to say. What we think about a potential future GroKo led by Friedrich Merz is that it's probably unlikely to push through any ambitious labor market reforms, as the SPD has quite close ties to trade unions and industrial unions in the country. And one of the pet policies of the SPD was the citizens' income, basically unemployment benefits, which the CDU wanted to get rid of, but that's likely to go into face significant opposition by the SPD. And a future GroKo is also probably going to be less enthusiastic about industrial policies than, for example, a CDU Green coalition.
Lots to unpack there, particularly that we're not expecting much change. But before we do, just talk about Friedrich Merz. How significant is it that he left politics for 2 decades? He went into finance. He was working as a lawyer, working on M&A deals. He's on the board of BlackRock. This isn't some bureaucrat that's come up through the party system and has remained there. He has this real world experience. He sat on that side of the table. Is that going to have any bearing on decision making, on the ability to effect change?
Friedrich Merz actually has a long history in the CDU, and he used to be a senior figure in the CDU, but he was ousted by Angela Merkel when she stepped into the spotlight of German politics. And that's when he left politics to pursue a career in business. And he's generally considered to be more conservative and less of a centrist politician than Angela Merkel, which is probably the reason why there has been a lot of conflicts between them back when they were both senior figures of the party. Today, Friedrich Merz has a much more hawkish stance on immigration than Merkel had it when she governed. And his hawkish stance on immigration has certainly dominated the election campaign in the last few months, or the German political media in general.
Can I say a word on the question of whether Merz will be different as a politician because of his business background? I think it is one of those things that remains to be seen, but people who are hoping for a more business-oriented government and the government that really is focusing on trying to get the economy going again, they will certainly have a champion there who's going to want to get taxes down, who's going to be backing business a bit more than Angela Merkel did. And I think in the current environment with the economy suffering so much, which we're going to probably talk about a bit later, that's helped people realize that there's more of a need for this business focus. But as Elias, as he was saying, there are going to be a lot of constraints on what he can do, not least the fact they have to reach an agreement in the coalition, and the SDP won't support all the same things. And his focus, I think, is very much on tax cuts as well, rather than on bigger structural changes. And there's a lot of talk about competitiveness and basically hoping that you can get the tax rates down and a little bit of labour reform, and that will be enough to revive the existing German economic model. And, I think a lot of people would argue that it probably is going to take bigger changes than that.
I think just going by Elias's description of him as a conservative, that in itself speaks to a very cautious approach to change, very cautious approach to governing. But maybe within this coalition system, it just becomes that much more difficult to push changes through. Never mind the kind of fundamental reforms that we're going to get onto.
Yeah, generally in the past, that has been a problem in the past three-party coalition, the outgoing traffic light coalition, that there were three parties part of the coalition that had quite fundamentally diverging views on how to revive the economy. And that's ultimately why the governing coalition fell apart, because they just couldn't find an agreement. Obviously, with a two-party coalition, that's less likely to be a problem, but still there are quite major differences between the CDU and the SPD on how to help the German economy. And it probably also means that any progress will be very slow and probably rather gradual.
Well, let's talk about the economic situation. 2013's German word of the year was Grand Coalition, as Elias taught me earlier this week. 2023's word of the year was Krisenmodus, which means crisis mode. And I think that speaks to this idea, this sort of national idea that Germany is in a crisis. Yes, it's to do with the Russia-Ukraine war and with what's happening in terms of energy supply and energy prices, but also the idea that the economic model is broken, that Germany's good times are over and that a new model is needed. So with all that being said, there seems to be a consensus recognition that something needs to change. What's the likelihood that we're going to get that change? Andrew?
I think, there's definitely a need for change. If we can we're just trading words of the year. I think the Zeitenwende was a word of the year just a few years ago, which is when Olaf Scholz had said that the country needed to change. That means a changing in the times. You had in mind both the need for Germany to step up in defense terms to deal with Ukraine, but I think a bunch of other changes as well, including weaning the country off cheap energy from Russia, and potentially its links with China as well. So there was this sense that a big change was needed a few years ago. There has actually been significant change. There's no longer significant amounts of Russian gas coming into the country. There has been an increase in defense spending. There are efforts to de-risk the relationship with China. So some things are happening, but the fundamental economic problem is that the economy is, in a way, an analog economy in a digital age, or it's a lot of the products that Germany produces are a little backward, looking a bit sort of old-fashioned. So, for example, most obviously the auto sector, which is primarily internal combustion engines and has been a bit slow to adopt EVs, but also a lot of the chemicals and metals industries, which have sort of relatively low value-added parts of the economy, which kind of have been in decline. So all of that is a little bit under threat. And I guess there's a sense that the strength of trade unions, a sort of corporatist model where a lot of companies that have been around for a long time, that are linked to governments, linked to unions, are not very nimble and not able to adjust to change very quickly. So I think personally, over time, these things will change. And if you look back 20 years ago or a little bit longer, Germany was considered the sick man of Europe for quite a few years. But it did change, it did reform. Part of that happens because the economy naturally reforms, and part of it comes through government policies.
Whenever you guys are writing about what's wrong with Germany and the future of the German economy, you talk about the industrial sector problems there. You've done lots of work on the auto sector in particular. In the same breath, you're also talking about the oddity that is Germany's fiscal stance.
Yeah.
Aren't you? Why can't they just spend more money? You'd run a much looser fiscal policy stance. You've got this EU debt sustainability model, and it's a dashboard that lays bare how weird Germany's fiscal stance is, certainly within the context of what's happening in the rest of Europe. But then you did this preview of this election, looking at the economic issues around it, and you make the point that as far as the manifestos are concerned, there is no consensus on changing the debt brake, loosening the debt brake, or just revising the whole thing entirely. How likely is it that we get any move on that?
Yeah, so just to take a step back, a debt brake was introduced back in the time of the global financial crisis, and it's a constitutional rule, or the so-called basic law of Germany, which requires the government more or less to run a balanced budget. There's a very small wiggle room, and there's some sort of details around it, but basically it's a balanced budget rule. And it would require a 2/3 majority in the Bundestag, the parliament, to get that revised. So it's quite unusual both to have such a strict rule, but particularly to have one that with such a high bar to change it, because that makes it so different from the fiscal rules in countries like the UK, where each chancellor comes in, makes up their own new fiscal rules, and then they can change it in a few years' time. So that's become a bit of a problem, because there is a consensus among nearly all economists and really among most of the people in the bigger parties now, the mainstream parties, that needs to change.
But not with Friedrich Merz.
Merz has increasingly hinted that there's room for some discussion about it. The CDU's manifesto says that they are going to stick to the debt brake, but it's very clear that they actually intend to change it if they can. So when he gets in, will be up for a reform. And in fact, we've been saying for a long time we thought it would be loosened, but not loosened dramatically. So I do think it will change. There is this question of whether they get the 2/3 majority. And so that is potentially a sticking point. I don't know, Elias, you might have views about that, but you need to get the CDU and its sister party, the SDP and the Greens will probably all need to agree to change the debt brake. And then they will need to agree on how exactly it's changed. And it can get very technical and it could take a very long time. So I think the will is there, but it might get bogged down. And also the extent of any change is going to be limited. Germany could happily say, we're going to spend another 10 or 15% of GDP on public investment, including support for green tech or rollout of EV charging points or subsidies for EV purchase. They could have some really big industrial policies. They could afford it, whereas other European countries really couldn't. But they're not going to do anything on that scale. I think it'd be quite modest. We've now said that rather than the deficit coming down to nothing over the next 2 or 3 years, it's probably going to stay at around 2.5% of GDP or so. So there won't be a big fiscal stimulus. It's just that they won't be tightening as we previously thought.
2.5% of GDP, it's still oddly tight in this environment, isn't it? It doesn't seem to...
Yeah, for a country whose debt ratio is quite low and where there's clear need for more public investment, plus this pressure now for increased defense spending, they don't need to run such a tight policy. And one additional benefit of increased spending by Germany could be a reduction in the German trade surplus with the US, which is something that President Trump is very exercised about. I wouldn't expect that impact to be very large unless Germany really focuses on buying more US military equipment, which could indeed be part of some fiscal package and could potentially get rolled into a sort of grand deal with the US if there is one over trade policy.
One of my questions was going to be if you were magically elected Chancellor of Germany. I know that's unlikely at this moment, but what would you do? And it does sound like a 10 to 15% of GDP spending.
Yeah, I think it would be a wonderful opportunity. I'd have to bring the rest of the Bundestag with me. But yeah, I think you'd go for a 10 to 15% of GDP public investment program. Some of it might be in the form of tax cuts. I think you'd want the government to push much harder on completing the single market within Europe. A willingness to allow foreign companies to buy German companies, for example, would be helpful. So there was an interesting case of UniCredit, clearly interested in buying Commerzbank, and the entire German political system was opposed to that, even though in principle they're in favor of a single market. So that's something I would think you want to change. A completely different attitude to immigration. Germany needs a lot of people to come in to do a whole lot of jobs because its demographic outlook for the next 5 years is really quite bad. It's worse in Germany over the next 5 years than it is in Southern Europe. That changes if you look a bit further ahead. But in the immediate future, there's a real squeeze. So they do need people to come in, do all sorts of work. And they particularly need to encourage people to come and work in skilled sectors and maybe priority sectors, such as digitalization, where Germany has fallen a bit behind. So I think if they had a push on those areas, that would certainly help.
And yet the themes that have come out from talking with both of you are along the lines of gradual and conservative and moving cautiously. And maybe there was a time when that was a sensible approach, but we live in a world of Donald Trump and Vladimir Putin and Xi Jinping and a rapidly evolving Chinese industrial base into parts of industry that Germany have dominated for so long. So it doesn't sound like there's much time. I do want to get on to where Germany/Europe fits into this more complex, more dangerous world. But just immediately, we've just had this reciprocal tariffs announcement from the White House. It doesn't sound like anyone's going to be escaping tariffs at the moment. Can you talk about how Europe/Germany fits into this evolving tariff regime that's coming from Washington?
Yeah, well, in principle, it looks as if it could be quite a serious threat because President Trump has said he wants to look at all taxes and other measures that would be considered discriminatory against the US. And in particular, he's included value-added tax within that. So the idea there is that because Europe charges VAT, but the US doesn't charge VAT, this is somehow discriminatory, and the US should therefore match that with a tariff roughly at the rate of VAT, which is somewhere between 20 and 25% in different European countries. So yes, you could get a tariff rate of as much as 25%. That would have a much bigger impact on Europe, potentially knocking 0.5% off GDP, perhaps more for Germany as it's more exposed. So it is a bit of a threat. However, I would say at this point, this is a very vague policy commitment from the US. It's not an executive order with a deadline to be implemented. It's a memorandum asking the US Trade Secretary and Commerce Secretary to look into all these measures and to come back with a proposal as to what the US should do. It could well be that gives room for negotiations, which is certainly the Europeans' preferred approach, which result in much lower tariffs or even the lowering of tariffs. At this point, I think we wouldn't be rushing to change our working assumption that there might be a 10% tariff by the end of this year imposed by the US on Europe, which would have a pretty small impact. There's also a question how Europe and Germany retaliate. And on that point, I think it's very clear that the Germans are not wanting to do anything that will escalate the problem. The whole approach from Europe will be to take measured, targeted tariffs to demonstrate that they too have the power to respond, but to do it in a very measured way to try to ensure that this doesn't turn into some kind of tit-for-tat trade war where tariffs go up higher and higher. Europe's still very wedded to the sort of global rules-based trading system and to the WTO, and anything they do is likely to be compatible with those rules.
It feels more and more like that approach is history, and that we are in a more, as I said, a more dangerous might makes right world.
Only to some extent. I think 85% of European trade is not with the US. So all of that is done under WTO rules, which is this most favored nation approach rather than the reciprocal sort of trade tariff approach that the US is considering. And so it may not be the way that the US is operating now, but I think much of the world will try to continue to operate with the pre-existing system.
Nonetheless, is there a chance with this in this world between Europe sitting between, you've got the US on one side, you've got Russia, China on the other side, and there's pressure on coming from Washington on Europe to increase defense spending, to take more of a role in security. You touched on this idea of greater European integration as well. Is there a sense that in this environment, these external forces will act as an accelerant on things like European integration and defense spending? I know you said defense spending has risen, but again, it's risen only gradually. To get to the 5% that Donald Trump's been asking for, I've seen estimates it's going to take another 10 years at the current trajectory. So do you expect this to be that moment, that crisis point in Europe that you like to talk about with regard to that quote from Jean Monnet, that things actually do get done?
Yeah, the quote that Europe is forged in crises and it's only in a crisis that they really get their act together. That has historically tended to be the case. I think it's debatable whether this will be perceived to be such a big crisis that it forces a change on a very big scale. Now, for most citizens in Germany, I think my sense is that there's a lot of frustration and a sense that the business model is old and fading and public investment is weak and public services are weak and trains are not running on time and so on. But it's not a crisis in the sense that there's massive unemployment rate or there's sort of people being locked down in COVID or that exchange rates are collapsing as they were in the early 90s or that you have this threat to the Italian sovereign debt market we had at a certain point not that long ago. So I actually, if you look at it in that context, this is not such an extreme crisis that people are feeling. I think it's because of that the politicians are not necessarily going to act as quickly as you might hope. So if they wanted to really move on the defense area, the thing that they should do is to increase the joint borrowing at the EU level, because that way you get around the problem that a lot of individual European countries are quite constrained by their bond markets. But if they go through the EU and it's all joint and severally borrowed, they can do so at a very low rate, so they could borrow quite a lot. There is a proposal out there from Poland and the Baltic countries and Greece, a few others have supported this, that they borrow about 100 billion in that way. So that would be a new version of the next gen EU borrowing that happened during the COVID. Firstly, that's quite small. 100 billion is 0.5% of GDP spread over several years. But secondly, up until now, the German politicians, including Merz, have been very staunchly opposed to additional joint borrowing. Now, it is possible that will change. Now, I couldn't get inside Friedrich Merz's head as well as Elias probably could. But once he becomes chancellor, faced with a really genuine problem over defense and how to support Ukraine, and with President Macron saying, look, let's do this, let's go and do some joint borrowing and shift things more dramatically, maybe he will see that as a better solution than trying to get more borrowing at a national level.
How much of that will depend on what's agreed in terms of the Russia-Ukraine war? Because it does sound like the US, frankly, wants to disengage from Europe.
Yeah, clearly the US is reorienting. It has been happening for a long time, and it's natural that it happens. For the US, China is their main focus now. During the original Cold War, the USSR was the main focus, so it is understandable. The way that Trump has done it has shocked a lot of people, and it's happened very quickly, though the details are yet to be hammered out, and it could take ages before we really know what happens. But yeah, I think a lot does depend on that. How many troops might need to be in Ukraine to support it and to ensure that the future borders are secure. It's a pretty serious issue, and I think that it's clear at this point how European governments are going to deal with it. I think we'll see more defense spending. We'll see more commitment on that area. There might be some sort of coalition of the willing that borrow jointly rather than the entire EU. There are all sorts of things that could happen. But I think typically these things are slow. Europe moves slowly.
Unless there's a crisis and there's not that recognition, even if it was 2023's German Word of the Year. That was Andrew Kenningham and Elias Hilmer talking about Germany's future. We've got a sizable and growing body of analysis on the fundamental issues regarding Germany and Germany within Europe. I will add some key reports to the podcast notes. I also mentioned our EU debt sustainability model, I meant to say monitor, that gives you a timely snapshot of the fiscal positions of the Eurozone's biggest economies, and there's underlying data in there and tools to integrate it into your workflow. I will add that also to the podcast notes. If you don't have access and you want it, then do get in touch. Also, look out for a drop-in. That's one of our short-form online briefings that we're holding on February 24th. So the morning after the voting, Andrew, Elias, and the rest of the team will be online to take your questions and talk through what we've learned. But that's it for this week. You can find all of our analysis on the platform. With everything that's going on in the world, you need the fullest possible picture of the latest macro and market developments and a bit of handholding by our economists. That's where our all-access packages come in. You get all of the written analysis, you get a whole array of data tools, and you get these engagement options with our economists. Find out more about these packages on our website, capitaleconomics.com. Neil will be back next week, where we'll undoubtedly be talking about the latest from Trumpland and much more besides. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.